So many challenges have been plaguing Canadians' personal finances. There's the high cost of living, the global trade war, there's the markets and economy going through topsy-turvy times, and it might have you, like me, wondering how you can better safeguard or even recession-proof your finances. Experts say there is no silver bullet, but there are ways you can better position yourself to weather an economic storm. Today on Blue Sky, we are digging into the discomfort of finances. Yes, in this economy. Financial planner and author Shannon Lee Simmons is here. We're going to talk budgets, emergency funds, investing, and helping your kids get a better head wrapped around finances. We also want to hear from you. Shannon has tips and tricks she's willing to take your calls to, or maybe you have a great new strategy that you want to pass along. I'm not talking about crypto. Call 1-800-716-2221 or email us bluesky@cbc.ca. My guest today knows a lot about money, and she can talk about it in a way that even the youngest people understand. Shannon Lee Simmons is a certified financial planner, chartered investment manager, life coach, best-selling author, and founder of the award-winning New School of Finance. Earlier this year, she released her fourth book, Making Bank: Money Skills for Real Life. That book is directed at kids. But let's be real, as adults, there is still a lot we can learn as well. I've loved her previous releases, Worry-Free Money, No Regret Decisions, and Living Debt-Free, and thought it was time for us to chat. Shannon joins us now. Thanks for being here. Welcome to Blue Sky.
Thank you for having me.
Okay, how are you? This book's been out for a couple of months. How's it been received by the audience, which should, in theory, be young people?
Yeah, no, it's been great. It's a national bestseller, which is very exciting. It's always validating when that happens. And I've heard a lot from teens have actually written me emails. I've been invited to speak with a bunch of high schools, which has been so lovely. That was actually, it was coming from, the teenagers who are on student council and stuff, which is lovely. And what's been a surprising thing is a lot of parents have written me and said, hey, I know this was supposed to be for teens, but I read it with them. And it's really helped me parent around this better. And also just I learned things too. So it's never too late to learn about money.
I was going to say, did you hear from parents as well who
Big
just
time.
so happened to be reading what their kids were reading?
Big time. I really, the adult feedback has been the most surprising because I didn't expect it. And it's been really positive as well. So I'm really thrilled.
What made you want to write a book about finances directed at young people?
Yeah, in my day-to-day job with New School of Finance, I deal with adults. I don't deal with kids. But a lot of my Gen X clients who have teenagers were saying, I'm really nervous about my teen. Can you just help them learn how to budget? Can you help with this? So I started working with some teenagers through those existing relationships, and quickly learned that this generation of this cohort of teenagers is very unique. Mm-hmm. They are up against a whole different sort of world, and immediately was I don't think we're preparing them properly. When they turn 18 now, they have access to an investment account, potentially online gambling, and tap technology credit cards. It's like being handed the keys to a Ferrari with only a learner's permit, and we are not, aware. It's coming. So I wanted to write the book to sort of help teens right now sort of practice the financial literacy that they're learning in school sometimes, so that they're best prepared to handle those high stakes situations that they're going to face when they're 18. They can buy cryptocurrency from their phone while watching a show.
Ugh, that's terrifying. Okay. Gen Z also is the first generation to grow up without maybe physically touching money, short of it being put in a card for them for a birthday.
Yes. And I think that is also a huge part of why I wanted to do this, because some of the Gen Z people that I'm seeing or talking to who are in their early 20s, we have stats to back this up too. Their credit card debt for Gen Z who's over 18 surged by 30% in the last year of loan. Most of that is just from credit cards. And they have, this is also statistics. Gen Z is facing a lot of financial anxiety. And I think it's all part and parcel. This generation and the one below in Alpha as well, they grew up not seeing money. I remember going to the teller with my parents on a Friday when I was a kid. I'm 40 right now.
You had a bank book, right?
Bank book. And they gave, my dad would take $100 out for the weekend. And then I would watch him give, $20 to the pizza man or $10 or whatever it was. And so there's a physical relationship with money that by accident is teaching you budgeting. I saw 100 and now I see less. That by you just realize like, oh, you have less now because you spent money. That opportunity doesn't exist anymore. It makes money completely cerebral. And my adult clients, I mean, it's why I have a job. My adult clients who have incomes are having a hard time with tap technology and budgeting or living within your means when you can just buy something by pressing a button and you never even have to see your income. So I think not physically touching money has impacted us in ways that I think we're just starting to realize now. And I've noticed it with the young people. Can you imagine it's like never seeing money, having everything be cerebral. You can have anything you want at the tap of a button. Social media is marketing to you in this aggressive way. And now you can just tap your way in a weak moment and it's done.
Well, this is the same generation that doesn't have to phone anyone for anything, and they can text or email everything and don't have to have those interactions with people either if they don't want to. Like the joke about not liking people becomes a real problem when you don't actually have to engage with a bank teller to input your money.
No. And if you want to open an investment account, you don't need to go and do that downtown. You don't have to go downtown and do anything. There's no barriers. Everything is instant and accessible. And so so much of that is so good in many ways, but we just need to like help them practice the skills earlier, because I think that turning 18 is like a financial ambush in a way that it just wasn't for my generation. You know, we were handed credit cards, but I couldn't tap my way to buy stuff.
You had to with the machine.
Correct. That's right. There was just more friction, right? Yeah, there was more friction. I remember even being like, when online shopping really started, and I remember one time my credit card was like in another room and I was like, I don't really want this that much. That doesn't even happen anymore. The physical act of getting up, you don't even have to get up. You can
because it saves to your phone or saves to your computer and everything is automated. Right. I'd love to hear from people listening in as well, what you were taught about money when you were younger and how you've adapted that over time, or what you've taught your kids because you wished you'd learned that sooner. You can call us 1-800-716-2221 or email us bluesky@cbc.ca. Shannon, what is it about money that makes us so uncomfortable in public? Like, clam up, start to sweat, so uncomfortable. Even having a conversation with my financial planner, there's so much shame that's associated with money if you are not killing it.
Yes, I think that there's many reasons for this. It's multifaceted. So number one, I think that our relationship with money starts young and starts early. So maybe you were passed on some, oh, we don't talk about this, or like, oh, they're rich, or, oh, they're not. Like, you pick up what's values around money from your folks. And that's like lots of people have different, sort of entry points on that. So number one, it comes from like how your relationship with money began a long time ago. And now as an adult, it continues to be shaped by the fact that money is how we pay for our life.
Yeah.
So if you don't feel like you're good at money, then what you're ultimately saying is, I'm not good at life. And I don't know that we ever say that, but that is why it feels so yucky when you don't think you're doing a good job, is because it's tied into our confidence. It's tied into our self-worth and our ability to have hope for the future. So if you're saying, if you know fundamentally that, oh, I want to go to school one day, well, that costs money. Oh, I want to buy a house one day, well, that costs money. I'd love to go on a vacation with my family, well, that costs money. And you don't feel like you're fundamentally a person who makes good financial choices, then you're ultimately saying to yourself, without even articulating it, I'm not going to get the things that I want, and I'm not capable of doing them. So the real shame around having someone else know that little secret you might keep for yourself is why we don't love sharing our stuff. And also, I think we're afraid of judgment. So just because I might love to spend money on puzzles. I actually do. So that's like not fake. I was going to pretend that it was a joke, and I'm like, no, let's just be real. But like, they're expensive, and I go through them at an alarming rate because I'm a dork. So like, imagine that, someone thought that was such a frivolous, silly expense, and that I shouldn't be doing that. I don't want to tell them what I'm spending or how much it costs necessarily, because I don't want them to shame what makes me happy. And so a lot of times we keep a lot of that hushed, and we talk around money. So
you have a term for those things, emotional.
Oh, a return on investment?
Yeah, emotional return on investment. Yeah, there's things that are the needs and wants of people are different when you throw in that emotional return.
Yes. And so when you're trying to reduce expenses, I always say map out your expenses. And like there's some things that you can't get out of, like your car payment. Okay, fine. But like where you have choice in your spending money, and rate them out of a scale of 1 to 5. 5 being like, would do it, maybe even go into debt to do so. And like 1 being like, I literally did this and then I regret it, or I don't even remember doing it. That's a huge thing now with online tap technology. I see a lot of, I get people to print out their credit cards, highlight the ones they don't even remember. Do you know how many there are they can't even see? They're like, it's Amazon. I have no idea what it even is. And that's because it happens so fast and so mindlessly. And so if you have some 1s and 2s that at the moment felt good, but then actually eventually caused you regret, or you don't like it, or social obligation spending, lots of that, make your reductions there first and keep the 5 out of 5. Even if somebody else tells you that your, coffee's expensive or your puzzles are expensive, like keep the stuff that makes you happy, because we only have so much money. And if we keep punishing ourselves with our spending money, then it's going to feel unmotivating. You're not going to stick to your plan.
What's the one thing people aren't doing right now that would be a game changer for them?
Oh, prioritizing emergency savings. So they are not sexy. They suck. It is like a, I say this in quotations, a high interest rate savings account. As interest rates are normalizing in the country, we don't have the same that they were a few years ago. They're not that high anymore. But an emergency account should be boring. It should be money that is liquid and not invested and just potentially keeping pace with inflation. That's the big job. That's just sitting there waiting for you to have something bad happen to you that you could then use that money. So this is not money that's invested in a TFSA. This is not money that's invested in an RSP. This is not a line of credit. One of the biggest things I hear is like, well, I've got a line of credit, so I don't need an emergency account. I disagree wholeheartedly. I have been on the front line of financial planning for 20 years. When there's an emergency and you have to go into debt to deal with said emergency, it is like kicking you financially while you're already down. Mm-hmm. And debt has this way of feeling like a hangover of a bad time. So every time you log into your, banking, you now see this decision that you made or this bad thing that happened to you, and it's still there, and it leads to this sort of like fear and resentment that doesn't need to exist every single day. And I'm not saying that every emergency can be held by an emergency account. I think that's a high standard that's not really realistic. But let's say that something happens, you have something happen in your house, your air conditioning breaks during a heat wave, and it's $6,000. If you have $2,000 saved up, you're going to feel better about that. Do you know what I mean? Than if you had to put the whole thing on debt. It just helps to feel slightly more in control and slightly less scattered when life throws you lemons. And we saw a lot of this during the pandemic when people lost their job right away. I saw this as well, like those with emergency accounts felt less scared, less anxious. And I also think that as the world is changing right in front of us with AI, and we have like lots of uncertainty in the job market, we don't know exactly, like everything feels a little bit precarious. At 3 a.m. to be able to log into your finances and see that you've got some money squirreled away is like a warm blanket of calm in a world that feels very nerve-wracking, so that you could, if your boss has a weird day and sends you a weird email, you're not spiraling on that forever, because you're like, you know what? I got my emergency account. Like, I'm good.
But what if you're someone who is trying to pay off debt? The idea of putting money away when you're being dinged with interest it feels gross.
Yeah.
As someone who's gone through that. So do you still prioritize like saving money at the same time you're trying to ditch some debt?
Yes. I would just change the quantities. So obviously high interest rate debt, I'm supposed to say, do that above all else. I'm talking about consumer debt here, talking about credit cards that's sitting at like 19, 20%. Financially speaking, that is the most efficient use of your money, but I wouldn't have a job if we all just made perfectly rational decisions. So I think that, thank God we're flawed. I think that it's really important to balance that feeling of like not failing at your debt plan. So what I think happens sometimes, like the whole point of an emergency account is to keep you out of debt, right? That's its job. So while you're paying down debt, come up with a sustainable amount of money. Don't do the thing where you're like, well, it's payday, so all of it goes onto my debt, and then I kind of like have to use my credit card to buy groceries, and then you're like, oh, I can't stop going into debt. And it's like, no kidding. You just put all your paycheck on the credit cards. You have no money left. Like, how are you supposed to buy groceries? So don't do that. Make sure you come up with a plan that's like, this is how much money I can actually sustainably put towards debt. And it may not be as dramatic. It may not be paid off in 3 months when I run this extreme plan that I can't actually stick to. Maybe it'll be 9 months. Fine, but I can sustainably do that, and I'll do that. That's much more likely to get done than these really extreme savings plans that I see people try to do. Make it sustainable. And in addition, I would have a little bit of money of like, let's say that you could save $300 a month towards your finances. Maybe you put like $250 to the debt and you put $50 to an emergency account. It may not even save the day. It's the mere act of putting aside money so that you are both planning for the future and paying back the past. The psychological impact of that is important, because what debt robs you of is planning for the future when we just focus on the past. And that feels really down, because you feel like everyone else, because social media distorts our view of reality, everyone else is building forward and I'm still stuck in the past. And so if you are saving a little bit at the same time, it can really have a motivating impact on you to like, okay, fine, then I'll keep paying off this debt for longer because I'm still building a life over here.
I think when some people think about financial planners, they think that it's only for people with money who can plan. Who benefits from a financial planner?
Literally everybody. Literally everybody. Imagine that you wanted to like, I don't know, get really strong and you got a personal trainer. You wouldn't say personal trainers are only for strong people. You know what I mean? Like you would be like, oh, that's how you get strong. And I think it's the same thing. I think we do fee only financial planning. So I don't have any sort of investment management minimum. So we see people from all walks of life, people who are like, do I need a consumer proposal? Right up to, I've just inherited millions of dollars. What do I do? And everything in between. And I can tell you that across the board, financial planning is for everyone. And I think that often there's a misunderstanding between what financial planning and what investment management is. And I think the terms, because of the word financial advisor, get mixed. So investment management is when somebody, manages your RRSP or TFSA and the money inside of it. So maybe they're managing it with mutual funds or something else. Financial planning is advice about how to plan your life and how to have the money to support that, whether it's retirement planning or school planning, or you want to go to school, you want to start a business or whatever. Sometimes you have somebody who does both. And I think we often think that a financial advisor is the person that kind of does both, but often the planning that a financial advisor does is mostly just retirement planning around the investment management. And they're not in the weeds in the day-to-day life around like your debt repayment, your life planning, all that kind of stuff. Some are, and that's amazing. Some are not. And so that's the difference. So I think everyone needs that financial planning and I think that's where the disconnect between is for people with money, because if we think it's just for people who have those investments that get access to financial planning, then we don't think it's for us. And that's not true at all. I think it's for everybody. And I want everyone to have financial planning in their life, because sometimes you just need someone to walk you through it, and it's not that complicated. And it seems so much more complicated when you head to the internet sometimes, because there's almost too much information out there.
So how do you, as a financial planner, make money versus someone who manages specifically investments or something like that? I think maybe some people hear, oh, I have to pay someone to do that, and I also can't afford to do that. So how do you make money?
Yeah, so that's a big part of it. So the traditional model with that financial advising or wealth management model, where I used to work on Bay Street. So this is that traditional model that most people are aware of is, oh, well, I get financial advice for free. And it's like, no, you're paying for that through the investments that you've got or through insurance products that you've bought or something like that. If you're fee only, which is what I am, it's literally like paying for like a lawyer or paying for like an accountant. So there's like, I give you my service, and then you pay, and then there's an invoice and you pay for it, which allows me to be unbiased. And it also allows me to work, with people that don't have $500,000 liquid to get in the door or $1 million liquid to get in the door. I definitely think that so that's how I get paid. That's how all fee only people get paid. And then I do think that there used to be a lot of, well, I'm in a financial mishap or in a hard time and I can't really afford it. And I think that that's always going to be the case. There's always going to be someone who thinks that. But I think the conversation in Canada around family planning, I mean, I've been doing it for 15 years now. It's one of the OGs. I mean, the conversation around normalizing it fee only has really changed. And so I do think that people understand the benefit, even if you have to pay out of pocket for it. And that's sort of, I hope anyways, I thought that that's becoming the norm. And sometimes a good referral is worth everything, right? So if somebody says, I need financial help, and someone's like, you got to see this person, and they're like, well, it's expensive, and they're like, but they will help you. That often will close the gap there as well. So if you've actually been helpful, then that goes a long way too.
Mm-hmm. You talk about money in a way that is really relatable. How much of the battle is people understanding those terms? I know we talk about contracts and people never read the fine print, but when it comes to finances, everything feels like fine print because there's so many different terms. When did you realize that you had to kind of break it down into a way that even kids can understand?
Yeah, I think like any industry, it has its own jargon, right? And I think it's just the stakes of the money jargon. Like journalism has its own jargon. Being a doctor has its own jargon. Every industry has its own jargon. But what's interesting about money is that the jargon is twofold. One, the jargon makes it feel like we know something you don't, you need my help. So there's that. And I think that that's part of the financial industry that it used to be. I think it's changing. But I do think that when we use jargon as professionals and someone is bamboozled or feels like, well, I don't know what that term means, then it's like, oh, let me help you with that. You know? So I think I wanted to change that for sure and make it feel very accessible. Like if I say fixed income and equity, I'm just saying stocks and bonds. That's all I'm saying. You know what I mean? And it's like, we don't need to use all the official terms all the time. And I also think that back to what I was saying earlier about money is how we pay for our daily life. Every single person has to make financial decisions every single day. So I don't have to be a journalist every single day. So I don't really care if I know the jargon or not, right? And I don't have to be a doctor every day. So I don't care if I know the jargon or not. But whether or not I packed my lunch today, took transit, drove, whether or not my kid's going to go into this camp. These are all financial decisions. So again, I'm looped into a universe where I feel like I should be fully participating, but there's a huge part of it that I don't feel like I understand. And that's what makes it stressful. That's what makes the jargon in this industry stressful for the average person, is that we have to navigate that world, but we're not really part of it. Like if you're not a financial person, then you're not really a part of it, but you're participating even still. So can you imagine going into a hospital and being like, code blue, like you're supposed to know all the things? No, but like imagine you were supposed to know all the jargon in order to get healthcare. And maybe there is a good analogy there, but like, you know what I mean? Like, but like it's its own language unto itself that can make an outsider feel like one in a place where they need to feel like an insider.
At what age should we start planning for the cost of life? Like, at what age should a kid have a bank account? At what point do we start talking about retirement? Like, what are the key milestones for money?
I think, with this book, I really felt like earlier, because of the stakes that are so high at 18, I've never felt stronger about that they need a chance to practice. I think the first checking account, not savings account, checking and savings accounts, should be happening when they get their first job, so that they can practice the habit of savings, which is my money comes in, whether it's through an allowance, part-time job, babysitting, whatever, a portion of it goes away. That dynamic right there that you're setting up, like it comes in and not all of it is for me. I'm saving a small part of it, or I'm saving a piece of it. That habit right there before 18, when they get a bigger job, it'll be the same habit they've been practicing for years. My money comes in, a portion of it goes away. This is for me. And like we practice. So that's a good milestone there. I think 18 or the age of majority in whatever province is a huge milestone, because you get access to all of these things. So at that point, I think that there really needs to be if not already, a literacy ramp up, because there's credit cards attached to like a digital wallet, investment accounts, potentially online gambling, depending on what province, all of that stuff. And so that's a big milestone age where teens reaching the age of majority need to like pay attention to make sure that they've got all the proper budgeting tools and all that stuff. And then as we get further, like it really is like choose your own adventure at that point. Like, like what what do you want to do? Where are you going to go? How are you going to do it? And so I would just say, like, we could skip right to the when do you start retiring piece, which is like asking how long a piece of string is. Everybody needs something different. I would say, as a rule of thumb, which everybody loves, is when you're around, if you want to retire about 15 years out from that date that you think you're going to slow down, you want to be making a retirement plan so that there's still lots of time to tweak the plan. Because the closer you get to that time, if there's something you should have done 10 years ago or 5 years ago, there's not a lot of time, and you're going to have to like really, really push your finances hard to do that. So I think, your 40s are a great time to get a really big long-term lens and say, like, where are we headed? Where are we going? Where are we headed? Where am I going? And like put some numbers to it and make sure that you're not going to end up scrambling like later on. And I also think that, like, what is retirement these days? It's really, really changing and shifting. I've been looking at people's money for 20 years, and the shift in what retirement has become is really, it's very, very different than what it was when I started.
What do you mean by that? Say more.
Yeah. So, okay. Nobody retired with a mortgage 20 years ago. It was just like, because mortgages were manageable, so they would be paid off. And so because housing prices were manageable with salaries, and that all changed over the last like 20 years. So I used a bit of hyperbole. Not nobody retired without a mortgage, but it was very rare to see that. I rarely saw it, if ever. Now, I would say it's pretty normal for like people to be retiring with mortgages. The goal I hear over and over with the, 45, 50-year-old crowd that's coming in for retirement planning with me is saying, or like my team is saying, okay, I can't pay off the mortgage because we didn't buy a house till 40, and we have a, $600,000 mortgage. It's not going to be paid off by then, but we think we can get it down to this. Like, what is that okay? Like, what's the amount we can wrestle it down to so we can afford something? So I think that the housing price piece and the amount of mortgage is not because people are irresponsible. It's the cost of living has skyrocketed and the cost of housing skyrocketed. So we have these 30-year mortgages that are lasting for a long time. So we have to financially plan around that. Number two, the idea that your income just stops and you go off a retirement cliff is really becoming only the norm for people with defined benefit plans. So your teachers, your federal workers, provincial workers, this kind of thing. It's really a hard thing. Think about this. Imagine you're 60 and you're like, well, that's it. And then you live to be 95. So I would like to spend money like my normal life for 35 years without working. What a wild expectation.
I know when my parents retired, I had a very hard conversation with them that was like, are you sure you have enough? And they were like, yes. And I was like, no, but are you really sure? Because I don't know that I can financially support you for the rest of your life. And there's that awkward question too of how long am I going to live? Which makes people really question their mortality, which is another uncomfortable conversation. And there's a good chance, like, do you have a will? Have you done your funeral planning? Have you talked about your living will? Like, the retirement question brings up a lot of other things that make people clammy and sweaty and don't want to talk about it.
That's why they're my favorite. They're my absolute favorite because I love to dig in the weeds there and get right in there. But these are the things that need to happen, right? And I think that question around longevity is also another shift I've seen in retirement planning. Like when I started, it was 90 and people were like, well, 90. And now people are like, well, my mom's 92. Like, you know what I mean? And so I think we're living longer and lots of stuff. So I really have seen this period of semi-retirement become the norm, which is like, cool. I'll save up. I'll get the mortgage wrestled to what I can. And then I'm not going to retire, but I'm going to slow down and I'm going to like coast till 70, 75, doing something I like for less money, but I'm not going to eat into my savings and I'm going to push out my CPP and OA. Like that, I think is the new trend because, back in the day, if you stopped working at 60, 65 and then like died at 75, like, yeah, you had enough probably. But like if you live to be 95, that's very, very different scenario.
Which is when you need money and care the most in some cases and when life gets to be the most expensive.
Absolutely. Yeah.
Okay, I would love to hear from our listeners, unless they're just nodding along or taking notes or something. It is odd to me that we have not had a question or an email come in. The number to call, 1-800-716-2221, or email bluesky@cbc.ca. Maybe someone has done something they'd like to boast about that's worked well for them. We would love to have you brag about your financial smarts.
Brag. Absolutely.
1-800-716-2221, or email bluesky@cbc.ca. I am wondering, is investing a gamble these days? We all watched what happened when Donald Trump took office in the States. We've seen what's happened with Tesla. Those two seem to be market manipulators for some reason. I think there is a good portion of the population that did not want to look at their investments or their retirement plans as the markets. I'm getting some nods from other people in the room here. It was uncomfortable. What do you do? Tell us what do you do?
I'm going to break down what you just asked, which is investing at gambling first, and then what do you make of it? So I do not believe that most investment strategies are akin to gambling, AKA, and here it is, the key to it all. Maybe that's why I know I'm just giving it away. Here we go. A well-balanced, low-fee, well-diversified portfolio. That matches your risk tolerance and time horizon. That is not a gamble in the sense that, yes, there's going to be volatility. There has always been volatility. I was working on Bay Street during the 2008-2009 crash. I saw people put lots of money in 2007 and lose half of it in 3 months. It was terrifying. And if I look at those people now, they have had an average rate of return of 5 or 6% over the last bit of time, and everything's sort of normalized for them. So there's always been volatility with investing. There's always been uncertainty with investing, and nobody has a crystal ball. And the best way to sort of defend against uncertainty is to control what you can, which is your fees. You can control that. Mm-hmm. You can control your tax efficiency. That's you're in your control as well. And you can control your asset mix, which is how many bonds and how many stocks, and making sure you're diversified. That's all within your control. And then you hope that you've got long enough that you can wait out any sort of volatility. That time horizon piece is critical. And then I'm going to get to your question about what do we do. Anything that you need in the next 1 to 2 years should never have been invested in the first place. So if you are 2 years out to retirement, the money that you were planning to pull to fund that retirement in the first 2 years has a short time horizon, in the same way that someone who's about to buy a house in 2 years and money is invested in their RSP also has a short-term time horizon. What I mean by that is you need the money in the next 1 to 2 years, so you cannot handle that chunk of money, not the whole portfolio, but that chunk of money can't handle volatility.
Can't disappear.
Can't even be down by $1. So it shouldn't have been invested in the first place, because what we want to do is always take a long lens. So when uncertainty, like what just happened with the tariffs, the big massive sell-off, what happened in 2020 with the pandemic, the big massive sell-off, you want to be able to withstand those storms without taking your money off the table at a loss. You don't want to crystallize that loss by selling. So don't check. That's actually the smartest thing to do. It's the best thing to do. And always make sure that the money that you need in the short run is not invested. And therefore, you don't have to worry so much when there's volatility that's completely out of your control. That has a long lens. Hopefully, the fundamental understanding is that markets will hopefully function historically as they have and rebound at some point, and then you won't have locked in a loss, and it goes forward.
Okay.
That's a long-winded answer to, as long as it's diversified. Where it gets to gambling is like day trading on a phone and following bets that are influencers being like, buy this, or like FOMO stocks on Wall Street bets. That to me is investing that it's akin to gambling.
Okay. We have a caller and we have an email.
Hey!
Stephanie is on the line in Regina. Stephanie, go ahead.
Oh, hello. How are you doing?
I'm wonderful. Thanks for calling.
Oh, thanks for having the show. It's been a lot of great information. I just wanted, when you put out the call for anybody that has something to boast about, I just wanted to brag a little bit about how I managed to buy my first home. I'm a little bit older, I won't say how old, and sort of had resigned myself to never being a homeowner. but had been saving on the side in hopes of just in case, hopefully maybe one day. And I was walking down the street and saw just a handwritten for sale sign in a window of a little house in Regina, not in the best neighborhood, but just handwritten. So right there on the spot, I phoned the number, and the person was like a real estate agent from Calgary who had bought up a bunch of houses probably, I guess, about 20 years ago when real estate agents bought a bunch of real estate in Regina and hiked the prices of everything here. And I asked how much, and he said 65. And I said, how about 50? And he said, okay. And I said, I don't want to pay a bank. Can you finance it? And he said, yes. And so I had paid not all of what I had saved up, a portion of what I had saved up as a down payment, and made monthly arrangements with him to pay him every month. And so I will actually outright own my first home in 5 years without having paid a bank a cent.
Wow.
Shannon has a giant smile on her face.
Yeah. So I think what this is a great example of is creative financial planning, right? And where there's a will, there's a way, and there's always hope, which are messages that I think are really important. And the consistency at which you saved and didn't give up because it felt hard or far away is how you were able to come up with that down payment one day. So I think there's so many lessons to be learned in that story. Thank you so much for telling everybody that. That's so creative and so wonderful.
All right, we have an email
Thanks for having the show.
Thanks, Stephanie. We have an email from Carmen. It says, hello, my partner and I connected with a local financial planner after the birth of our second child. While on maternity leave, we met with someone at Independent Financial Services and talked through the registered education savings plan for our children and whether we could afford to become a single income family for a few years while our kids were young and I wanted to stay home. Talking to an experienced financial planner led to some hard conversations, but ultimately getting to chart our own path. Can't recommend it enough for new parents who are in the thick of it.
Yeah, agreed. And that's why, back to that original question where you said, we can't afford to do it. Like if you're feeling like it's tight, there's often a way through, and there's often hope, and there's often something creative that can happen that can't just be found by Googling. It's something that there's an anecdotal evidence, there's a conceptual problem solving that's happening and creative problem solving that's happening to see something as a whole picture and then synthesize a solution that is emotionally satisfying and financially savvy at the same time. Take that, AI. And so you know what I mean? It's all encompassing. And so I really do think that sitting down as a team or even individually and mapping it out, it can make you feel so much better and put you on the right path where you actually get to where you want to go.
Shannon, you are spicy about AI. How does AI impact finances?
Who knows yet? I think I am spicy about AI. Is it showing? Okay, so I think my worry is actually larger than just finances. I think it's like my worry. What I've seen are lots of people who have been laid off this year and clients who have come to me saying, oh my gosh, I got laid off and I'm having a hard time getting replaced. And so I've seen that over and over with specific industries where AI is being used as the sort of reason for the structural unemployment that they're experiencing. So I think what I'm actually nervous about is the structural unemployment across the board around different industries, hitting each industry differently, that could lead to, people having harder and harder times finding meaningful employment as the cost of living continues to rise and wages become harder to get in a labor market that gets trickier. Someone's going to be eye rolling at me for sure, calling me a Luddite. Totally fine. I hope I'm so wrong and out to lunch. I hope I'm absolutely wrong and out to lunch. And great. That would be wonderful.
We have an email. Dee wants to know, there are folks who might have money in stocks, etc., that might not align with their values. Is there a way of making sure you're investing in ethical companies?
Yeah, that's a great question. Okay, so number one, there is something called ESG testing, which is environmental social governance testing. And you can find this most financial institutions have some products, which are ETFs or mutual funds, that are ESG tested, and they're usually called socially responsible investments. So this is where it's like a package of securities, a package of stocks, where the companies that are inside them have gone through some sort of testing, which is not standardized in Canada, by the way, to say, okay, we're going to have some financial companies in this fund, but we are going to test each one for their environmental impact and their social governance, and we're going to rate them, and we're going to pick the best ones. So we've done this analysis to make sure that we're trying to have a good caliber of diversified stocks in this product, but also of the ones that have gone through this testing. So that's usually the most easy way to get access to it, right? Is that someone's done that labor and then you buy the product. The other thing you could do is DIY it. And it's, again, for our earlier conversation, it's never been easier to buy stocks from the comfort of your couch. But I would say you want to make sure that you're just doing your research on that and that you are diversified. So like you can do that through ETFs as well. You can do that through buying securities if you've done some research to make sure that there are companies that align with your vision and your values. What I see a lot of these days, though, is with that, people say, "Oh, I bought one exchange traded fund, one ETF, and this stock." And it's like, great. Well, I hope that I bought the S&P 500, this ETF, and it's like, and this one other stock. I was like, well, I hope that works. I hope that nothing bad goes wrong there because you're not diversified at all. So just being really aware of day trading, not even day trading, DIY trading rather. Sorry, not day trading. They are very different. And just making sure that you're properly diversified. That would be the one thing that I would say you just want to watch.
We have another email from Moreno. It says, advice given in youth that got put into action that has us happily retired. 1, always seek professional help with all matters beyond your scope of expertise. If you have a sore tooth, you go to a dentist. Sorry state of finances, seek a financial planner, and just as quickly as you would go to the dentist. 2, avoid investing heavily in rusting or rapidly depreciating commodities. Invest within your means. Buying something beyond your means to make appearances or be trendy is a waste of time and money. 3, do not waste time on complaining or blaming politicians for your woes. That is a victim mentality that fixes absolutely nothing. It's up to you. Whenever you point the finger of blame, there are 3 fingers pointing back to you in blame. My parents said that a lot when I was a kid. And then I'm just summarizing because this is quite a long email. Life will always give you situations that are 100% out of your control, but there is one thing you are always in control, 100% control of, and that is your reaction. It can be complain and blame or put effort or sacrifice to rise above whatever challenges brings us, and it goes on. But I think that some of that is good advice. Cam also emails, what are your thoughts on labor-sponsored venture capital funds? That's very specific.
It's very specific and out of the scope of what I'll go into today. But here's my advice to you. They can be very expensive and they can lock in your money for a period of time that maybe you're not aware of. So they're also different. The reason I won't go into it is because each one is so custom that I couldn't possibly give any sort of advice on it. I would say, get very clear on the product that you're investing in. I'm not saying that from a bad point of view. I've seen these be great. I've seen them be not great. I've seen both happen. The ones that I've seen that haven't worked out is that someone didn't fully understand what they were investing in. So it wasn't that it was a bad product, is that they didn't understand what they were doing and then felt like they didn't mean to sign up for that. So just make sure that you're very aware of what the terms are and what the fees are, and then if it feels right, then great. Then that can be a really great thing to do because there are some benefits there.
I want to talk to you quickly as we're coming up on the end of the show about New School of Finance because you don't sell financial products.
I do not.
Tell me about the New School of Finance if people are listening in and they're thinking, I like what this lady is saying. What can I learn?
Oh my gosh, I hope everyone's thinking that. We do fee-only financial planning. So we are holistic in our view and unbiased in our advice. And we're certified financial planners. So you can find us at newschoolfinance.com. We do everything from like household financial planning, which is how do I navigate, all the things that are coming at me. There's sandwich generation, becoming a caregiver, retirement planning, everything in between. And yeah, we've been around for a long, long time. We've been around for 15 years. So we know what we're up to and we're a lot of fun.
And you have classes too, right? If I was looking on there.
Yeah, we have some online courses that are for people who are learning how to freelance and the taxation on that, for people who are, it's called Budget with Your Boo, which is adorable. If you're like you moving in with someone or you're just starting a life together, like how do you like navigate finances together in a way? But those are the online courses, yeah.
Everything is so much more expensive these days. Where do you think people should be focusing their efforts?
Income diversification. So I have I've always seen this be something that's helpful. I think it's gone from helpful to necessary. And that to me is, okay, what do I mean by income diversification?
Yeah, I was going to say, what does that mean?
Yeah, it means in the same way that you wouldn't put all your eggs in one basket for your investments, don't put all your eggs in one company for a paycheck. So, and I'm not trying to be discouraging, but if there's other things, if there's ways that you can say, okay, my skill set is something that I could be employable. If I lost my job here, I could get a job doing these skills here. Maybe you have a side hustle. I know everyone's going to eye roll because they're like, oh my God, I'm already so burnt out. But always thinking about ways that you might be able to make money should you lose your current position, or like, is there ways that you can have other sources of income coming in? As we battle things, like when the pandemic happened, if you lost your sole income, it was like, oh my gosh, what do I do? I don't have any other options. So even if you don't do anything to diversify your income, maybe start the thought process in your head. What would I do? What could I do if I needed to make money in a different way? Just so you're thinking about that, as like a different revenue stream in your life, so that if there's bumps along the way, you've got something else that's kind of in the background, or that at least you've been thinking about it, so it wouldn't come as a total thought exercise in a time of crisis. You don't want to be having that thought exercise in a time of crisis. So have it while you're employed gainfully and like you have time and bandwidth to think about it. And the other thing that I would do when it comes to just sort of planning going forward and where your efforts are, think about something that I have coined your replaceable income, your easily replaceable income. And what that means as well is like, okay, don't inflate your life to match your peak income that you're earning. So if you are making $120,000 a year, $150,000 a year, and you're like, I'm killing it, this is amazing, and now all of your expenses blow up to that amount, then if you hated your job and you wanted to quit, now you're beholden to that income. So now you're miserable. If you got laid off and you only got offered 110, that's still a great income, but now you're beholden to this extra money because your lifestyle has inflated to that point. So if you have the privilege of do that.
Shannon, thanks so much for all of this great information today. We've appreciated your time so much, and I know people got a lot out of the show. Thank you.
Thanks so much.
Shannon Lee Simmons, certified financial planner, chartered investment manager, life coach, author, and founder of the New School of Finance. You can find more from her at shannonleesimmons.com. As you can tell, I'm a big fan. And she joined us from Toronto.